Australia's thin capitalisation rules apply to Australian taxpayers with debt deductions of greater than $2 million. The rules deny deductions for a portion of interest expenses that exceed the prescribed limit. To comply with the rules, a majority of Australian taxpayers will seek to rely on the general safe harbour limit, which establishes a maximum debt amount up to a certain debt-to-equity ratio. For non-financial entities, that ratio is currently 60%. The current global COVID-19 pandemic has highlighted the need for taxpayers to regularly monitor compliance with the safe harbour limit. Any changes in the Australian capital structure, for example, impairment of Australian assets, undertakings which significantly reduce the Australian cash position, and increases in Australian debt could result in a breach of the limit. Where this is the case, taxpayers have a number of options under the law relating to alternative averaging valuation methods. Companies facing significant impairment of assets could, for example, consider more frequent valuation points to smooth the impact on balance sheets. There are a number of practical considerations for taxpayers in such an undertaking, including, for example, the availability of reliable accounting records. Where the safe harbour limit is breached, there are two alternative methodologies available to taxpayers. The arm's length debt test is an annual test that requires analysis for taxpayers' Australian business and funding in order to determine a notional amount of debt that would reasonably be expected from the perspective of both an independent borrower and an independent lender. The test requires certain factual assumptions and consideration of each of the relevant factors outlined in the legislation. This involves an analysis that is broader than traditional transfer pricing analyses, and it should be noted that taxpayers with third-party debt, for example from banks, may not automatically qualify for the ALDT, particularly where that debt is guaranteed or where the taxpayer has foreign business assets. The ATO has released draft guidance on the ALDT in September 2019 that contains a number of helpful clarifications for taxpayers, including, for example, the fact that asset values used for the analysis can depart from accounting values in appropriate circumstances and with appropriate support. The guidance contains a clear emphasis on appropriate and robust documentation and analysis where taxpayers seek to gear above the safe harbour limit. Taxpayers should consider their existing ALDT positions and documentation in light of this guidance. Companies that would have been able to rely on the safe harbour test but for the impact of COVID-related balance sheet effects should also consider the eligibility for applying the simplified approach to the ALDT announced by the ATO. For all taxpayers, it is critical to regularly monitor compliance with the thin capitalisation rules throughout the year. This allows early identification of potential issues and provides flexibility to prevent the denial of deductions. The options available at year-end and at the time of filing the tax return can become significantly limited.